Hi, my name is Jeff, and I'm one of the senior brokers at World Financial Group and part of the Soaring Eagles team. So welcome for all of you who are part of this team. This is for you. This is our edition of How Money Works. And the reason why it's important to first learn about financial literacy is because you want to also change your legacy. You want to be aware of where your money goes. It's not how much you make, it's how much you keep. And here are some of the things I'm going to share with you today that the banks won't tell you and schools won't teach. So hopefully you get to take some notes and use this to improve your life as well. So let's begin. So it's important to first understand why people fail financially, so that way we can avoid, be aware, and avoid. So once you're aware, then you know exactly what not to do. So your chances of succeeding is a lot higher. You're in a better position to win. So the 5 reasons why people fail financially. The first one is failure to plan, procrastination, no money wisdom, misunderstanding tax laws, premature death. So these are each of the items I'm going to go with you over, and that way you understand and be more enlightened. And again, to avoid, don't repeat the same mistakes that most people do. So the first one is failing to plan to set goals. So where does all your money go? Have you ever wondered, paycheck after paycheck, at the end of the month, you pay your bills, you go buy some groceries, and then there's not much left. Sometimes it's very hard to save a few $100s at the end of the month, right? To save for your own future. And this is the reason why most people have very little at the end of the month. It's because when you make a paycheck, a big portion goes to taxes. So this is a must. We can't avoid them. But what happens after that? We use the leftovers to pay for our bills, our rent, or mortgage, our car payments, and then lifestyle. You want to enjoy life, right? You work so hard, 40, 50 hours a week. You want to be able to stay sane. So with that being said, the very tiny area at the end, it's what's left. No wonder why people are very inconsistent when it comes to saving for their future. So here's a little tweak, a little perspective that I want to share with you, because that is the solution. You want to begin to plan right away by paying yourself first. Be disciplined. Okay. So right after your taxes, you're going to quickly put aside a fixed amount and then live within your means. Necessities, that's your bills, your car payments, and your lifestyle. Okay, so this portion is the savings, the forced savings you have to do, because money is your best friend. You save it now, it will save you later. Okay. So don't save what's left after spending, spend what's left after saving. Number 2, procrastination. It's always about doing it tomorrow. I'll start my investment plan next month. I'll start my insurance plan next year. We'll see what happens, right? Human nature. So here is another perspective to show you the cost of waiting. If you have $500,000 at 65 as your goal, as your target, how much will a 20-year-old have to put away every month if it's earning an average of 10%? So as you can see, $49 a month is the goal per month to reach $500,000. Not bad. The earlier, the better, right? Now, what if the 20-year-old decides to wait 10 years later? How much harm could there be waiting 10 years? So a 30-year-old to begin that plan would have to put in $130 a month. Okay? It's a lot more now because the deadline is still the same, shorter time frame, so you have to catch up a lot more. And if you wait till 40 years old, $375 a month, okay, to get the same amount at the end. So it does pay to be aware and to be knowledgeable in terms of when to begin. There's no better time than now. Here's another point of view. If a 40-year-old puts away $100 a month at 10%, this 40-year-old will grow $133,000 at 65. Now, if this 40-year-old had started 10 years prior at age 30, it would have more than doubled, $382,000. And if this 30-year-old had waited 10 years prior to age 20, $100 a month at 10%, over $1 million. So that is the power of time. When you start early, Time can be your friend or it could be your worst enemy. So it doesn't matter how old you are right now, the plan is to start right away. And that is the solution. Begin to plan right now. The third option, or the third reason why people fail financially is no money wisdom. There's a lot of people out there that want to save money, that want to invest, but they just don't know how because the schools don't really teach you that much. The banks don't tell you. So we're off to fend for ourselves, right? We're just learning from other people that may or may not be experienced. And it's kind of like the blind leading the blind. So here's a quote from Albert Einstein. Talks about compound interest. Okay, that's the equalizer. Compound interest is the greatest mathematical discovery of all time. It's the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So the lesson is money can work for you or against you. So here's what he means. On paper, if you had a 30-day work contract and your boss says to you, I will pay you $1,000 a day for 30 days straight, side A. Or option B, your boss will pay you a penny a day, but that penny will double every day for 30 days. So what does that mean? It means that 1 penny will double to 2 pennies on the second day, and that second 2 pennies will double to 4 pennies on the third day, and so on and so on, and all the way to the 30th day. Now, based on this face value, which side seems more enticing, right? So the average person will probably look towards A because it's predictable, 1,000 a day, that's a lot of money. At the end of 30 days, that's $30,000. Why not, right? This 1 penny doubling a day, I don't know, right? They might be thinking, how much could it really evolve at the end of the 30 days? So let's find out together. So let's look at side A. After 10 days, you'll see that no-brainer is $10,000. Now, how about this 1 penny that doubles a day for 30 days? What does that mean? It means in day 1, you earned a penny. Day 2, that penny grows to $2, it doubles. Day 3, it doubles to 4, 8, 16, 32, all the way to $5. Imagine working 10 days straight just to make $5, right? Which side looks better right now? Of course, side A, right? So most people, yes, now because they think they know better, they go to side A. So let's look at the next 10 days, okay? So from day 11 to day 20. So here on this side, you'll see that 20,000, and that $5 will now double to 10. That 10 doubles to 20, all the way to 5,000. So looks like side A is still in the lead. But let's look at the last 10 days, the impact of compound interest. This is like snowball effect, right? So this side, as you all know, will reach to 30,000, okay? Clear, done. Now, that 5,000 now doubles to 10,000 on this side, doubles to 20, 40, 80, 160,000, 330, 670, 1.3 million, 2.6 million, $5.3 million. Can you imagine? Who would have guessed a 1 penny doubling every day for 30 days will grow to $5 million? Nobody could foresee that. That is the power of compound interest, right? So now you know that compound interest is a big factor to growing your money. You got to make it work for you. Now, another concept I want to share with you is called diversification. So what does that mean? It means don't put all your eggs in one basket. So let's imagine yourself with a beachfront house with a massive window, right? As you can see here, the window is bigger than the front door. Your next door neighbor has an 8-year-old boy who's very naughty. He comes over one day, throws a rock at your window and completely, right? Now you got to replace that whole window again. So that's what most people do when they invest. They speculate. They put all their life savings into one stock company. And then if that stock company does well, great, you make money. But if that stock company goes bankrupt, you lose everything. Okay, so don't do it that way, not with your hard-earned money. Instead, what should you do? Do it this way. Set up panels. So if the same neighbor, the kid walks over with a rock and shatters one section of your window, guess what? You just have to replace that one section. And that is your portfolio. Yeah, that's where you now diversify. Investment diversification. So the same amount of money that you plan to invest, spread it out evenly. So that way you're averaging your risk as well, okay? Here's another concept, payment diversification, also known as dollar cost average. So what does this mean? It means with a fixed period of time, you're going to put in fixed amount of money, regardless of the market going up or going down. You take the emotion out of the equation. So in this scenario, from January to June, if you put $100 a month for 6 months, that's $600 of your own money. Now let's look at a bad case scenario. You put it into an investment that costs $10 a share, and in February it drops to $5. It loses half of your money already, half of the value. And then it drops to $2 and to $1. Oh my goodness, it's down 90%, right? And then finally in June, it creeps up to $2. So overall, this fund price is a negative 80%. So did you make money, lose money, or break even? Let's find out together. Let's look at the number of shares you purchased, right? Because that $100 in January would have bought you 10 shares because the price is at $10. In February, even though the price dropped to 5, you're now buying 20 shares, right? You're buying more. Think of it like a discount or a Black Friday sale, right? People tend to buy more with the same amount of money. So in March, April, May, they buy that many more shares. And in June, they buy 50 shares more. So if you were to add up all the shares from the time you started, that's 330. So even if you were to sell it today at $2, okay, not 10, at $2, how much will it be worth? 330 shares at $2, $660. So did you make money or lose money? You made $60. And as a rate of return on your investment, that's a 10% return. So even though the market dropped 80%, you still made 10%, right? How much do banks give you on a high interest savings rate? 1%, right? 2%. Guess what they're doing with your money? They're investing it. They're doing this because they understand how money works. So this is to show you that it is possible to, with discipline, take the emotion out to still make money in the long run. Number 4, misunderstanding tax laws. So here's an example I want to share with you. What happens if you have $1 that doubles 12 times because it's tax deferred, okay, like an RRSP. So your $1 doubles to $2, it doubles to 4, 8, all the way to the 12th time. So by the 12th time, it's $4,000, okay? Now, what if you took the same dollar and you put it into a non-tax sheltered account, like a non-registered, some open account, and each time you double your money, you have to pay the average 33% tax bracket. So when your dollar doubles to 2 minus 33%, it's $1.67. And when the $1.67 doubles again, minus 33%, $2.79. So at this rate, how much would it look like at the 12th year? $400. That is the difference between knowing and not knowing. So you have to know the basics because it is a life-altering event that could be very successful to you when you retire or catastrophic. You can go broke. So here's one thing you want to know about the Canadian government. When you earn your money, no matter what, they're going to tax you. When you spend your money, they're going to tax you there. When you save it in the wrong area, they're going to tax you there. And did you know when you pass away, that's when they tax you the most, right? It's called probate. So that is another chapter your trainer is more than happy to share with you. But yes, there is no escape. You will always have to pay. And the biggest bill is at the end when you pass away. So when you're aware now, you got to be more involved with your own money. Don't let other people tell you what to do with it. You got to learn it and fend for yourself. So here's the good news. A lot of people have a legal right, okay, of a taxpayer to decrease or minimize your taxes if you know how. And some of the ways we share is through RSPs, charitable gifts, tax-free savings accounts, IRS, that's called Insured Retirement Strategy. I'll explain about that more later. And starting a business. Why not? There's a lot of tax perks when starting a business and a lot of tax write-offs. So it's great that if you're part of the Soaring Eagles team, you're on your journey to become a business owner. So the IRS is what I'm going to shed some light today because a lot of people don't know about it, and the banks don't talk to you about it because they're not allowed to sell it. They don't offer it. Only insurance companies sell it. So IRS stands for Insured Retirement Strategy, and it's basically cash accumulation inside an insurance plan. Okay, and that's a strategy that wealthy people use as well. So the fifth one here is called premature death. Okay, that's another reason why people fail financially. We can't predict when we're gonna pass away, so why not plan ahead, right? Plan ahead through life and wealth insurance protection. Protect your loved ones and protect your money. So when it comes to insurance, there are three main types to be aware of, and it's all about suitability. It's not about which one's better than which one. It's all about which one suits you the best. So in order to find out, you got to learn about the different types so you know which ones. So the first one is called term life insurance. So what is that? So here's an example. A 20-year-old who wants to purchase a $500,000 policy for 10 years. Okay, there's a term 10. That's what it's called. How much will it cost per month for this 20-year-old? $28, not bad. But because it's only for 10 years, if this 20-year-old wants to extend it, renew it for another 10 years, it's going to cost $90 now because they're 30 years old now. It's based on your age when you convert or when you renew. For a 40-year-old, $121, $257. By the way, this is per month. $600 a month, $1,600 per month. So that's crazy. So term is designed for short-term solution, not for long-term. So if you know you need it for maybe a house mortgage that has 10 years left on your amortization, then get a 10-year term. That's it. It serves a specific purpose. Now there's a 20-year option if you like, and for a 20-year-old, a 20-year duration is $36 a month for 20 years. As you can see, it's a lot higher than $28, but lower than $90, right? And so that's from 20 to 40. Now from 40 to 60, it's $150 and then $980. There's a 30-year term. Again, it's about suitability. What do you need it for, right? So it's $48 a month for a 20-year-old. And then when this 20 becomes 50 years old, $630 a month. And this can extend all the way to 100, okay? So it's up to you how you want to use it. There's also what's called term to 100. So if you don't want to think about it, you just want a flat rate and never go up. As a 20-year-old, $170. Okay. Now, a second type of option is called whole life. So earlier we talked about term. Think of term as renting, okay? No money back, you get what you pay for. Whole life is now more of mortgage. So you pay a little bit more, but you own it. There's equity inside. There's cash accumulation. So how does that work? Let's say a 20-year-old purchases $500,000 whole life. For how much will it cost? It's going to cost $300 a month, but only have to pay for 20 years. What happens after 20 years? No have to pay anymore. They own the policy stays with you forever. Okay, so that's the good part. Now, in this whole life policy, there's also money that's accumulated that you can have access to. So with these specific ages as examples, you'll see here that out of the 500,000, you can retrieve this much money and you can spend it for yourself. You don't have to wait till you pass away for your family to spend it. You can spend it while you're alive, okay? So that's some benefits that a lot of people like. And then there's a universal life. That's a third type of insurance. Basically, it works the same way as the whole life, except the difference is here. You can see the cash values are a lot higher in this illustration. But here's the pros and cons. The reason why the whole life numbers are lower is because it's actually guaranteed by the insurance company. The numbers at the top is not guaranteed. You decide where to invest, right? The insurance companies decide where to invest your money at if you choose the whole life. So it's a predetermined 3% average per year, okay, type of account. Here, like I said, you determine where to put it, so you can invest it. And if you can average a 6% type of return, average it over the years, then that is where you see the cash values. So how does the stock market look like? Because it's very scary. A lot of people are not aware and not used to seeing, beyond many years, and they don't even know the history. So here's an example to put you at ease. I know the numbers here, the font is pretty small, but if you focus your eye on the bottom left, it says 1934. So from 1934, if you have $1,000 in the stock market, how much would that $1,000 be worth today if you just left it there? So it now depends where you invest. If you put that $1,000 at the top line where it's the blue color, that's the US stocks. So from 1934 all the way to the year 2020, that 1,000 would have now grown to $9.9 million today. That's averaging 11% return per year. And this is during the war, during the technology bubble, and all of those in wars in between, and recessions and depressions, right? Now, if you put that same 1,000 into the Canadian market, it would have grown to 2.3 million, averaging 9%. If you put it into bonds, thinking it's safer, well, your 1,000 will only have grown to 144,000 today. And look at this, inflation, more reason to invest instead of saving, because this tells you that whatever you can buy for $1,000 at 1934, you will have to spend $18,000 today to buy the same thing per 1,000, right? So that is the power of inflation. It creeps up on you and it erodes your purchasing power. So you have to find a way to invest for the long run if you want to retire properly. So now that you have money inside the insurance plan, how do you take it out? This is called the Insured Retirement Strategy, IRS. This is how it works. So number one, you obtain a universal or whole life policy on yourself. You pay no income taxes on any interest, dividends, or capital gains in your portfolios while accumulating. So part of your monthly commitment is to pay for insurance, and the difference goes to investment. Now, number two, at retirement, you assign your policy to a lending institution. Think of it like a home equity line of credit. You paid off your house, the house belongs to you. Now you can bring it to the bank and set up a line of credit and use the money against it. So use the cash value of your policy as a collateral for a loan. Step number three, receive the borrowed funds tax-free. So now you can use it for a variety of things, such as supplement retirement income, taking vacations, gifting, taking advantage of other investment opportunities. And then pay off your loan eventually with the insurance proceeds. So the loans are eventually paid off by the policy's tax-free death benefit, which includes the payment of the insurance component and the fund value you have built. And any extra that you have not yet used will go all to your beneficiaries tax-free as well. So this is the life stage of the insured retirement strategy. And that is something that, again, is to shed light that there are avenues out there that can help you minimize tax and take advantage of tax incentives. So as a recap, these are the 5 reasons why people fail financially. Remember, it's important to be aware so you can avoid failure to plan, procrastination, no money wisdom, misunderstanding tax laws, and premature death. So now you know what to avoid. Your solution now is to start right away with your trainer. You've also learned about how important it is to have money to start with. Doesn't matter how much, just start right away and have time as your friend to allow it to grow, and proper rate of return. Don't put your life savings in just a checking account or savings account earning 0.5%. Inflation will eat it away, okay? And this will give you the opportunity. Of course, you gotta beat inflation and minus taxes. And that is your true wealth formula, okay? So thank you very much for listening to the How Money Works session. Please book your next appointment with your trainer. They're gonna see how this can apply. Any of these things can apply to you personally while they complete your financial needs analysis. And if it makes sense and suitable, fits within your budget, definitely take advantage of it, because it's just going to help you and your family get to have a better future later on. Thank you so much for listening in. I'll talk to you next time.